You are listening to Mining Stock Education.
We've dug into some PEAs recently, and PEA is a bit of a loaded word. These are not ready to go. You can tell in some of these PEAs they have not been thought through, all the way through to empty sections. They haven't thought about deep costs in much detail, and I would put my finger on the PEA level studies that you want to be a little bit careful around.
Welcome to Mining Stock Education. My name is Brian Leni. Today on the podcast, I'm joined by Michael Sinden, Managing Director, and Gordon Sorbring, Director of Costing and Engineering at Costmine Intelligence. We'll be diving into their expertise on mining costs, project evaluation, and the data that drives investment decisions in the resource sector. Guys, it's great to have you. Mike, let's start with you. Let's have a quick introduction to what Costmine Intelligence is.
Yeah, sure. Thanks for having us, Brian. If you don't know Costmine, we're also, one of our aliases is InfoMine, which might be more familiar. Ubiquitous in universities, engineering consultancies, engineering departments at the miners. But really what our core proposition here is high quality proprietary cost data, specifically equipment, OPEX and CAPEX, labor and salary data, which is then couched in a cost estimation layer that we call Sherpa. So we're able to take all that cost data and help mining engineers and cost estimators put together pretty accurate, detailed, and fast cost estimates to build and operate mines. That's in essence what we do here. And we've been doing it for 40 years. We've got a great team of mining engineers and geologists. In our heart of our business is in Spokane, Washington.
Excellent. You both have decades of experience in the sector. Mike, starting with you, looking at the sector today, what has changed the most over the course of your career in terms of the cost side of projects, and why does it matter to investors?
Sure. Yeah. Well, as we know, it's cyclical, this industry. We're stuck with the cycle, one you can almost set your watch to. But if I refer maybe just to the last sort of cycle that we've been observing, which was really driven by the pandemic, the big thing that we saw in our data was everything went up is the short answer. But I think the question is what is going to come off the soonest. So we saw through the early 2020s, we saw labor across the board, salaried labor, hourly labor, all of it flew up dramatically. We saw equipment. And if we pick apart the equipment, it's the CapEx and the OpEx. So things like the cost of steel, the cost of hydrocarbon linked things. So fuel, lubricant, any types of other energy, mill liners, tires, all of that saw a lot of cost inflation in the early half of this decade. So up to sort of 2020 through to 2023, 24. So the question now is, what do we think is going to come off? And what we've noticed is the labor story continues to actually be quite hot. We are still going through collective bargaining agreements, and so labor continues to be quite hot. What has come off is some of those hydrocarbon linked inputs that I referred to. Those have started to come off a little bit, but kind of like other things you see in life, prices don't necessarily come back down. They stop going up. So a lot of this cost inflation is now baked in. So while labor continues to go up, the floor is higher for some of those other items that we've seen.
Right. Well, talking about the hydrocarbons, do you foresee that as something that's like a structural change, or, because we've seen commodity prices change, it's very much cyclical. So this is obviously the down part of that. So you do see that cost, going up and down in the future, especially with some of the, the carbon tax or these different things that are linked in Canada, especially. So how do you view that as something permanent, or obviously it's going to change?
Yeah, it's a good question. I think you'd have to take a view on oil price fundamentally, right? At the cornerstone, if you just look at your Brent benchmark as the core driver, the keystone of whatever other energy prices do. So I think if you took a view on Brent, which has been fairly flat, it's sort of succumbs to geopolitical events and things like that. But I think if you took a view on Brent and just said, look, $70 Brent is what we're going to live with, and that's my assumption, I think a lot of things flow on from that. Hard to predict these geopolitical events, obviously, which can obviously throw a wrench in the works. But yeah, I think it's your view on Brent ultimately. One wild card I would say though is if you look at some of the charts that are out there on solar generated electricity, like some of these, I mean, this hockey stick just keeps going up. So that could be a bit of a wild card, is if electricity costs can sort of come down or at least stay predictable? That's a big question mark with AI and data centers and all of that. The demand for electricity is going up, but there are a few wild cards in that energy story, and it's an energy analyst's sort of dream, right? To have to sort of think about all these different factors.
Hey, Gordon, you're an engineer by background. When you look at the alternative energy sources, such as the solar panels, that has become quite popular in the PEAs, the PFSs that I've been seeing. How do you view that from a cost standpoint moving forward? Is that something that stabilizes cost, or is that as much volatility as what carbon could be?
It's really new in the industry. We are adding battery electric vehicles to what we offer on capital operating costs at Costmine. Definitely, there are pressures from investors and people on the boards of mining companies to be greener. ESG is so important now, environmental and social governance. And, if you can get green credits, I worked for a gold miner 10, 12 years ago, and we looked at pumping water from, the top of a hill and putting it through a turbine and seeing if we could get, green credits or power part of our mill. So it's really important. It's coming. It's still somewhat in its infancy, but we do have a demand for, battery electric and other electric forms of equipment.
Okay, so what are you using as your database for those figures? Like, what other industries are you pulling on? Because, like you said, like in terms of the mining industry, you probably don't have as many comparisons or data sources to sort of seek that out.
Right now, we're going to the manufacturers who are making battery electric equipment. Right now, I don't know if we've really gone into the sourcing of whatever hydrothermal or solar panels or anything like that. It's definitely a way that we could be going.
In terms of, going further with that energy and ESG, do you foresee carbon credits and that sort of thing being a part of a cost database, or is that something totally separate?
I think it's definitely going that way. I think there's no doubt. And especially the two of us, Brian, sitting here in Canada, there's a lot of opportunity there for Canadian mines to generate credits that way. If you can get onto the grid connected to hydro, I think there's a lot of opportunity there for sure. I think if you could think of creative ways to generate electricity using solar panels, you can generate credits that way as well. I think abroad, that's a different story. You'd have to see if, there's opportunities to generate, electricity with wind farms, et cetera. We don't specifically do different costs for different power sources. But I think what we can do is look at the offsets and different trade-offs, and we can talk about EVs as well. We're in a great position to do trade-off studies with EVs and then a hydrocarbon equivalent, and what the trade-off is both on the CapEx, but then on the OpEx. So we can definitely do great cost analysis on that from that perspective.
Yeah, and there's a lot of talk about, hydrogen-powered vehicles. One of the things that we are offering in our, diesel engines for the most part, gas engines, is the carbon footprint, the amount of carbon that is coming out of the engine as a column in our operating costs. So engineers and geologists and other scientists who are doing these technical reports can also grab from our offerings and see what the sort of carbon footprint will be from the mining and I believe the milling equipment, Mike?
Yep. So we're offering a really good Scope 1 emissions for all the equipment OpEx as well. And then to that, you can attach a carbon price and work out your exposure.
Okay. In terms of studies, there's a plethora of different studies out there. And of course, each company that's developing a project comes out with a PEA, a PFS, feasibility study, and then hopefully a construction decision. With the data that you guys have collected from real operations around the world, maybe more specifically with North America, do you see any sort of disconnect in terms of the technical studies that are being produced today and what you're actually seeing from a cost perspective?
Gordon, Gordon's doing this right now. I'll let you comment on what we're seeing. So just to reframe the question a little bit, what a PEA or PFS says versus our independent assessment of these projects.
Yeah, I worked a good many years in the industry as a consultant, and I think what we offer is independent cost analysis. A lot of the times, unfortunately, my brothers and sisters in the consulting industry aren't really allowed to be independent engineers. I'll say that nicely. There are, downward pressures from the client to really hit certain metrics in the cash flow, let's say. And, let's face it, all the easy ore deposits have been developed. It's tough out there, and you have to have good designs and engineering to make something go. And of course, commodity prices are king. So we are seeing, financial organizations getting a little frustrated because the tech report says we could do it for this price and we can build it in this many months or years. And, a lot of the times that doesn't happen. Yeah.
So how about, so there's an obvious disconnect between reality and what some of the companies try to project. Is there any commonality in terms of what specific points in the cost data are different or are mostly different? Like, is it in the OpEx? Is it in the labor cost? Is it in the energy? Where do you see the most significant difference?
One big one, if I can chime in first here, Gordon, one thing is not a particular item, but it's assumptions around the ramp-up period in the pre-production phase. So, and maybe if they absolutely nail the cost, the CapEx, the opportunity cost is not 3 years or 18 months, it's more like 4 or 5 years to ramp up to full production. So that's not a specific piece, but it's an assumption around the ramp up time and the capex, to be fair, sometimes too. But that's a big one, right? If you think about the opportunity cost of not hitting nameplate in 2 years, but hitting it in 4 years, that's a real opportunity cost. That's one item. I don't know, Gordon, if you've got anything that comes to mind.
I'll circle back to ESG, environmental and social governance. There isn't a risk assessment out there done on a mining property that basically doesn't have, permits and permit duration at its top, and that's really something that you can't control. The other thing is there's a timestamp, obviously, on any tech report out there, and the clock's ticking from the time you've done the tech study to the actual time you're doing designs for construction and actually procurement and constructing the property. So I will, go back and defend the consultants and the mining companies for that. It's, economics are a moving target, let's face it. And you can have a local populace be in favor of the mining project and then, turn 180 degrees on that. And in many places you can't control it. But, part of the thing is, even at a feasibility level, I once had a boss say to me, listen, our technical report is feasible. It's not optimal. And so, you have to be aware of hanging your hat too much on that technical study that once the construction group comes in and people sharpen their pencil, they will optimize things. Now, that might mean one less ball mill, or it might mean more. So I guess that's what I'd have to offer to jumping from a PFS or an FS to the construction of the operation. And, now they're billions of dollars. So
if I could throw one more thing in too, Brian, if you look at some of these studies, there is a quick and sometimes or absent reclamation estimate. And that's, if I can make a plug for one of our offerings, which is a really great reclamation cost estimation tool, it's the absence of reclamation estimates. So that doesn't hit you right away, but that's going to hit you down the road. And one thing, if you think about the way we do a cost estimate, it's almost a checklist as well. Have you thought of all these things? It's a very rigorous, comprehensive way of doing cost estimation, and up to and including the back end of the life of the mine, the reclamation costs. And if you look at some of these studies, it's a pretty, like I said, sometimes it's absent altogether, or sometimes it's fairly quick and laden with assumptions that are maybe not correct.
Right. So the absence of a reclamation cost, that's an obvious red flag, like how an investor could look at a DCF within the technical study and say, hey, look, that's a huge mistake. Like in Canada, I know, for instance, a lot of these open pit copper mines in BC, for like you're talking $50 million. Yeah. And I don't know necessarily where that ranks, but that's a large amount of money to plug in that last year or 2 years of your DCF model.
Yep.
And so you said now there's a time element, and that has to do with permitting and some of the social things that can pop up. And an engineering firm or a company doesn't really have control of this to an extent. But let's say that's going well. In terms of the engineering companies that execute on these technical studies, and I'm not asking you to name anybody, but do you see a difference or a consistent difference in the various companies that do the technical studies? Like, this engineering firm is pretty bang on in terms of being close to where they should be, and like vice versa on the downside end. I don't know if Gordon would be the best to answer that.
I've in my experience seen some firms that might be a little aggressive in their capital operating costs. But the way I look at an engineering firm, I know a lot of companies, sign contracts with them for the logo. I still look at a consulting firm, an engineering firm, as the quality of the people they have, under that logo, which can change, from year to year, month to month. And so, yeah, there are some that maybe are a little, more aggressive than others. I think it comes down to how much leeway they have. And again, plugging our offerings, we're independent. We're not, working for a banker or a mining executive. So,
because what I'm trying to drive at is, like, from the investor perspective, like, obviously you said, some of these people, you've worked with them, the ones that definitely know what they're talking about, and maybe the ones on the other side of things. But how does an investor look at a technical study, look at the cost data, and what factors should they be looking at that are the red flags? Like you mentioned, the reclamation cost. That's a great one. What other hidden factor or cost line item can a guy look at and say, hey, look, you're missing this, or you're way off on this? Like, there's got to be a hierarchy in terms of what to look for.
Oh, I think we hit some of the checklist items, So, like, have they got a sensible pre-production period? Have they thought about reclamation? Is it comprehensive? We've dug into some PEAs recently, and PEA is a bit of a loaded word. These are not ready to go. You can tell in some of these PEAs they have not been thought through, all the way through to empty sections. They haven't thought about costs in much detail, and I would put my finger on the PEA level studies that you want to be a little bit careful around as you progress through the pipe. They get a little bit more. The confidence interval is a lot tighter, but we've been seeing PEAs there's a wide array of variability in the PEA levels, and it's these check marks, that we were talking about, ramp up periods, reclamation estimates, things like that. And that might be a chance to say one more cost item that we see that people get wrong is because of these aggressive timeline assumptions, that hits your labor very quickly, right? Because your labor's there. And so the labor costs I would highlight as another one that can flare up and be fairly wrong because of the timeline estimates and the workforce you got on site. And just to say too, we do work with the gamut. We work with small one-person consultancies all the way through to the big fellas. And just so we do have a good view on that. But I'll rather than pick on the company, I'll pick on the stage of the study. It's the PEAs that I would, if I'm an investor, I would just keep your wits about you.
I would say as an investor, short of getting a mining, geology, or metallurgical engineering degree, you obviously need to educate yourself. I think in this day and age where data is so plentiful, you can go out and see, for example, if copper was the thing that you were focused on as a green metal, take a look at how various porphyry copper pits, for example, went through the design stage into construction, and get that, and take that data, graph it, and then look at maybe a green fields or a brown fields and see how they stack against that. So that's how I do it. But I would still at least understand the geological terms, the met terms as much as is reasonable.
How about jurisdiction? a lot can vary cost wise, and even going into those other factors, environmental, permitting, social license, can vary by jurisdiction. Do you have much data outside of North America in terms of comparing Canada and the States to Mexico or Europe? What could you tell us about the cost differences and how they vary?
We're a North America first organization. We've done a lot of work in the past year scaling out our data to international, both from a labor perspective. There's some great sources of information out there to help us transpose our labor data to international. So that's one thing. On the equipment, CapEx and OpEx, we have an international audience that uses our data, and they find it quite effective. There are ways you can flex the data to just adjust for things. It's probably not the cost itself. It's more the extras like shipping, tariffs. We've been talking about tariffs forever in our data because that's a fact of life, right? Importing equipment into West Africa is going to cost you money, and that's not new. It's cool and the topic of the day, but that's always been a factor. So it's those components that you kind of have to think about as opposed to the core cost of the equipment, because we have a big audience that uses our data for international. The other point I'd make about that too is that you'll have Western developed country companies, mining companies, building Western standard operations in developing markets. So I think about Kazakhstan, I think about Mongolia, I think about Pakistan. We have Western companies building Western standard assets in those jurisdictions, and they're building it properly, so to speak. They're building it to a high standard. Investors are also keen on that too. If they're financing a mine in Kazakhstan, they're keen that is built to a high standard for future investability. Because if it's built at a lower standard, that asset suddenly becomes not investable. So you're finding that some of these mines built by Western companies are built to fairly high standards. So there's not a lot of arbitrage in equipment, labor, and things like that. Is what we're finding.
I can recall in college when we were doing mineral economics, you want your payback period, if you're in a risky jurisdiction, to be obviously much shorter, to be able to get your money out, to state the obvious. And there are publications out there that rank mining friendly provinces, states, and countries that, I think an investor should be aware of. But I would have a different cash flow for a given country that was more risky than maybe Nevada or Saskatchewan or Alberta.
Especially the discount rate and the cost of capital, right? Like that's such a big factor. And in terms of the timing, that's the first thing that popped in my mind when you talked about the ramp up period. I think that's what a lot of investors get wrong in terms of what they do with the DCF. A 2-year versus a 4-year ramp up is so much different.
Yes.
The cost of capital, what that means to the NPV is huge, especially you get up in those 10 plus discount rates. AI automation, it's the talk of the town right now. That's seemingly where everything is going. How do you incorporate AI and automation in terms of costing moving forward?
So at the moment, we're tackling electric vehicles. That's been the big milestone for us in our business and our data sets. AI and automation, that's sort of the next frontier for us. We haven't tackled that. The lessons that we learned in the EV story, though, was the companies like the miners and the OEMs were a little coy in talking about that and just sort of showing us their cards in terms of what these things cost. And that's kind of the same over on automation and AI at the moment. So we're not quite getting that data that we want. What we are hearing about that, though, it's definitely, and we're hearing it consistently, it's not a cost play. It's an efficiency play. It might be a safety play. It might be, it's just different. And it's certainly not cost is what we're hearing from an early stage, because you're replacing certain types of roles with software engineers, for example, and that's not a cost savings. So that's what we're hearing now. But I don't know, Gordon, what have you seen and heard in your experience on AI and automation?
I'm using, automation, definitely the major players are offering, autonomous vehicles and using that underground. I think that's at least a dozen years old. I observed it, many years ago in Northeast Nevada. The AI, more in my job, I'm finding, our costs are based on, talking to vendors, and OEMs, to get capital operating costs, and then marrying that together with us building them from first principles. And, AI is really helping us with data out there, validating those two sources. So I think more for, my job, the way I am trying to get more and more accurate costs out there to the industry, that's how I'm seeing it. From the manufacturers themselves, I'm not really seeing it yet.
So at a university, I worked in steel manufacturing, and I was on the management side. I was process engineer, and then I got in the managerial. And we were looking at automation, and we used a lot of the safety, the environmental efficiency jargon. And part of it was to deflect from the unions on what the sort of the root was, because it was to reduce labor. Yep. And you couldn't get around it. Like, I'll give the example where our steel plant was 1 million tons per year capacity. We had, roughly 300 hourly employees and 100 management. There was a comparable brand new mill in Germany that was 100 hourly and about 20 management. So like drastically different set of circumstances. And yes, it was safer. It was more environmentally efficient. But in the end, it was amazing how the discrepancy in labor costs, which for us as Canadian producers was such a big line item in our breakdown. So it's just interesting from my perspective, because that's my practical side of things. Yeah. You guys have worked with cost data across a number of commodities regions. What patterns consistently separate projects from the next?
My first instinct, Gordon, is to go to processing. I think there's more and more esoteric ways of getting to a unit of metal now. And I think digging up stuff is changing a little bit. But from what I see, our flow sheets, we're in a constant battle to keep our flow sheets up to date. And these new and exotic ways of getting to a unit of metal is getting more and more complicated, weird, if I can use that word, expensive, energy intensive. That's kind of where my mind goes on that question. Particularly with, you've got new technologies in leaching with copper, or you've got a strong preference in the iron ore market for high quality beneficiated pellet, right? How do you get to that really high grade pellet? What is the processing involved there? That's kind of where my mind goes, Gordon. What do you think?
I agree with you. Mineral processing, metallurgy, that's really very important. You just have to look at the capital costs of a mill versus a mine. They're usually manyfold to do processing. I'd say, again, out of one side of my mouth, I'm saying to investors, understand the industry, but don't go out and get a degree if you don't have to. But on the other hand, I've seen challenges where, maybe the tech study didn't consider a detrimental element like arsenic's favored in gold. Too much arsenic and your recoveries just tank. Another example that I saw was an agglomeration plant in a heap leach project where it was cut from the feasibility study when they went into construction, and there was just too many clays in the ore. And again, recoveries tank. So I would say those are the things. Make sure that the metallurgy and the metallurgists have done their homework and work. And, in the PEA, PFS, that's when you look at multiple options on processing and what could derail, getting north of 90% or something recovery. Because, commodity price and mill recovery, that's very important.
Gordon, I'm interested. One of the things that I've heard is kind of become in vogue, and I think it's driven by the fact that capital has been really hard to come by. But a number of companies have told me that they want to go about doing bulk samples, and they're going to toll mill it at X and X mill that's got open capacity, and we're going to be able to create this much money in potential revenue, and then we'll use that to explore more. And really what I've seen and what I got from my conversations, these guys are like talking about doing toll milling on their potential deposit not into infinity, but it sounds like that's the direction they want to go in terms of raising money, non-dilutive, but of course it has the downside of actually milking the deposit that you're trying to develop into a mine. So what do you think about the bulk sampling? Is that something in terms of cost, in terms of an engineering perspective, should that be sort of ubiquitous in the sector that a mining operation should do some sort of bulk sample to prove out costs and viability? Or is it just what I'm describing almost, that this is just a kind of a fad in terms of raising money?
I'd always say, if the financier is large enough or has, the money behind them and is serious about a project, honestly, having been there and done that, Mike, hiring a consultant to do a due diligence for you, and we touched on metallurgy, to me, there's a lot of value there. It might be an expenditure of tens of thousands of dollars to save you millions. So I would have the client do the bulk sample, but bring in your expert to review it and look at the data room, et cetera, et cetera. Some of us can't afford that, but, definitely that's the way if you can. To really have transparency before you invest.
Gordon, another one for you. You've had a long career. You've seen a number of different things. In terms of projects that you've seen that's come across your desk and you say, oh, this looks like a good one. Have you had any that have looked good and then ended up in disaster, and why they might have ended in disaster? Is there anything that stood out?
Other than my story of the arsenic and the agglomeration plant, those are the two that the execution just wasn't there.
Because there's the interesting example in Ontario with Rubicon. I don't know if you guys are familiar with that. That's probably a good 10 or 15 years ago. They tried to go from PEA to production, and it ended up being a disaster. And I can remember, not necessarily people I respected, but I remember before I was doing this full time, there was like a few people that kind of touted it. And it just amazed me that there was that much of a disconnect. And that project went from, I think it was around 3 million ounces to now they think it's probably at best 500,000 or 600,000 ounces of gold. And it was just a complete disaster. So I suppose it's a story on what you said about PEAs, is that you really have to be careful at what you're looking at.
Yeah.
Inflation. We sort of touched on it a little bit, but moving forward, is there any type of, are you using CPI, like when you're talking to companies and advising on how to project things into the future, are you using CPI? Or are you using any type of metric to project, labor costs, fuel costs, materials into the future?
I'll take that first. That's a good plug. So one of our deliverables for our clients are mining specific cost indices, and they're quite granular. We use Bureau of Labor Statistics in the US, Australian statistics and Canadian statistics to formulate those. They're mostly hindsight, but they are very detailed. And I think it's really important that you have a mining specific index. That's just important because there's all these idiosyncrasies in our industry, isn't there? And to the extent that we've got underground indices, surface mining indices, mineral processing, coal processing, everyone's got a different cost structure. The pie chart for all of these things looks a little different. At the moment, we haven't got into forecasting. We've dragged forward a few things with some interesting outcomes, but forecasting isn't something we've gotten into yet. We would certainly like to. If I had to go about doing it, I would put on the OPEX side, I would put a lot of work into the labor side of things. And I think that's where, like I said earlier, where we've been surprised on cost inflation. So I'd put a lot of work into labor, and I'd put a lot of work into your view on steel and hydrocarbons, as we discussed. That's where I would put my effort, and we're going to hopefully staff up on that side soon to do forecasting.
Yeah, the consumer price index looks, basically, kind of a bag of groceries, versus, what we have is, what's the cost of, iron, concrete, diesel fuel, things to build a mine. So, I'd say get specific to the industry that you're looking at rather than CPI.
Yeah, and CPI, I think for most of us is kind of a crock, considering they change that basket of groceries seemingly every few years to suit what they want to project, right? And so I suppose that's what you're describing is picking a niche basket of things to project forward that's specific to mining. That makes complete sense. In terms of where you're seeing the direction, do you see by metal a concentration in terms of customers or people seeking your services? Like, is there any metal in particular you're seeing right now that is sort of driving things forward?
Gold.
Yeah.
Yeah, gold and copper. We have a new initiative where we're costing real life assets ourselves, just like our customers do. And we're just following the interest. So that's been copper for sure. Dr. Copper, you can't avoid it. But gold, love it or hate it, gold is interesting to our customers, and that's what we're going to do. So we've been costing out real life gold projects as well. I'll just add one more. As we talk to our clients, particularly the ones on the financial side, investors and banks, I've been very interested at the continued interest in high grade iron ore, like I mentioned earlier. That just seems to be a very resilient story. So, and that's an ESG story really too, right? Clean burning, if you like, iron ore pellets of very high quality from either, Newfoundland or the Labrador Trough or Western Australia. So that's been a surprise to me. So copper, gold, and high quality iron ore.
And so like in terms of the metals and sort of your bulk, because I'd almost classify the iron ore as like a bulk material or an industrial commodity. So do you guys get into the bulk commodities too in terms of costing and that sort of thing?
Absolutely. Yeah. So I mentioned the iron ore. We do a lot of work on coal as well. I mean, it's a dirty commodity. No one likes to talk about it, but at the end of the day, it's still a huge proportion. A lot of coal comes out of the ground just in the US alone. And then on the Canadian side, lots of high quality coal, metallurgical coal, coming out of the ground in BC, right? So I don't think that market can be ignored. And I've been a big fan and big interest in metallurgical coal. The problem is it just gets lumped in with the thermal stuff, right? And so it becomes uninvestable, unfortunately, for a lot of investors. And so it just gets sort of swept under the rug. So yeah, we do a lot of work on coal, a lot of data sets available to help on costing for coal washing, prep, mining. Yeah.
The uranium space also is doing well. Its spot prices, I think, are between $70 and $80 a pound. And we offer an in situ leach model for your specifically uranium. So,
Gordon, like a mentor told me, he said, in terms of bulk commodities, he said it's all about where you're located. Because the costs and then the quantities that have to be moved your transportation becomes the big point. The crossover in between, or is there a crossover where you can get a mix where that's not necessarily the case? Or like what might be the case where, something might be a little bit more out of the way? Is it all dependent on grade, or how would you look at that?
Yeah, it's revenue price. And I see most industrial mineral companies and mines still in metropolitan areas. I grew up in Canada, and so I was, up in the Arctic and northern Canada. But industrial minerals, transportation is king to the market. So yeah, if you're in the outskirts of a major metropolitan area, you probably got a good deposit there.
Right. And so would that be the key piece of data that companies are looking for from you guys is basically transportation and how that differentiates?
Yeah, we offer a transportation module or section on what that'll cost. One company that I worked for was shipping their run-of-mine ore to a kind of a hub and spoke mill. And so in that case, transportation and logistics going through, major towns was important or is important to them.
Mike, Costmine Intelligence, take us through the services you offer and where we can find you guys, website, social media.
Oh, brilliant. Thanks, Brian. Yeah. So like I said, the cornerstone of our intellectual property is our equipment cost data, OPEX and CAPEX. So we have an equipment cost service there. We've got a mine labor service that does much the same. So very detailed mine labor costs that we update every year. We do that just the old-fashioned way, doing channel checks with HR managers at mines. And as Gordon alluded to, talking to all the OEMs. So that's the cornerstone, is high-quality raw data. Over top of that sits the analytical layer, which we call Sherpa, which are the cost models. So we run the gamut from surface, underground, mineral processing, and reclamation cost models that consume that data and help put together sensible CapEx and OpEx. And then soon to be released is our new product called Woody, and that's bringing everything together, which is a property database that we also maintain. So real life properties, going through that whole analytical layer I described and putting out our own independent view on projects and operations. So we'll be doing some marketing around Woody over the next few weeks and months, and we're really excited about it. So putting together really high quality, fast, independently thought through cost curves for projects. So that's coming to a shop window near you on our website. So look out for Project Woody coming at you.
And do you guys have a social media account at all?
We do. Yeah, LinkedIn is mainly where you're going to find our stuff. You can go there and see some of our content. Costmine.com is probably the best place. Sign up for our newsletter. We do monthly newsletters that keep you up to date with what we're releasing, new content updates, data dumps, etc. And a lot of free stuff there as well. So yeah, have a look at Costmine.com.
Excellent. Well, guys, thank you very much for coming on the show. I found your insights tremendously valuable, and hopefully you can do it again soon.
Appreciate it. Thank you, Brian.
Thanks, Brian.